today. Just on the behalf of CCPA, we really just want to extend our heartfelt wishes that everyone is healthy and that people have the support that you need to endure this trying time. We are all navigating this unknown territory, and we want to assure you that we are going to be by your side every step of the way as we figure out how to help Philadelphia's business community overcome the challenges that lie ahead. We will continue to shift our programming and networking offerings to best support our members and guests, and we want to hear from you. So if you have comments, suggestions, things that you'd like to see for future programming, please let us know. You can even put them in the chat feature today. So welcome to our virtual Lunch with City Leaders. I'm Suzette Mahoney, a partner at R2L Restaurant and the president of CCPA. We'll touch on a few details about today's events. We are recording this so we can share it afterwards. You are encouraged to use the chat feature to ask questions, which we will answer throughout the program. Feel free to comment, make suggestions, and connect with each other. As Ben said, we will mute everyone to maintain audio and visual controls, but we may invite you to unmute at certain times. So I think we touched on this a little earlier. As a reminder, this is not a webinar, so you are live on video. We can see you. We prefer it this way so everyone feels engaged, but certainly if you need to take care of business, feel free to turn off your video. CCPA is an intimate and diverse group of business owners, executives and managers looking to build relationships and offer each other meaningful resources. That hasn't changed. We will continue to bring you unparalleled access to speakers, decision makers, and leaders who are shaping Center City. We will also continue to keep you, our members and guests, informed about business challenges and opportunities in Philadelphia and help you become Center City smart. We appreciate our members and guest support, especially now as we work hard to get through this. Thank you to everyone who has renewed their membership, made a donation, or are sponsoring an event. We are very grateful. And if you are not a member, we would love to have you join. To touch on a little bit of our future programming, at this point, everything will continue to be virtual. So our next Lunch with City Leaders is June 4th with Jim Friedlich, the CEO and Executive Director of the Lenfest Institute for Journalism. On July 15th, we have the President of the Federal Reserve Bank of Philadelphia. Join us May 29th for a happy hour breakfast with City Council members, and you can find a full schedule of events on centercityproprietors.org. I'd like to acknowledge our sustaining sponsors, our preferred benefits provider, Michael Craig of Penworth Financial, and WeWork, which is the home of our headquarters when we're not working from home. Finally, I'd like to acknowledge our event sponsors who, even during this time of crisis, have continued to support this series and make these events possible. Arsenal Media Works, the Community College of Philadelphia, Friedman LLP, KYW News Radio, Lev Lane, Pico, Post Brothers, and Visit Philadelphia. Our presenting sponsor is Citizens Bank. I'd like to welcome Dan Fitzpatrick, the president of Citizens Bank Mid-Atlantic Region, to say a few words and introduce our speaker.
Great. Hey, Suzette, thanks so much. You can hear me okay?
Yes.
All right, great. Hey, well, good afternoon, everyone. And on behalf of Citizens Bank, we are really proud to be the presenting sponsor here and support the Center City Proprietors Association, all the good work that's happening. And Suzette, you know, special thanks to you, and we look out for you, and we all look forward to going back to the great restaurants in Philadelphia like R2L as soon as possible. Hopefully we can be supporting you through takeout orders and the like, but we all look forward to when we can safely return with spacing and all appropriate measures to be safe and take care of our great restaurant business in Philadelphia. But Citizens Bank, obviously, we're the bank with the most branches in the city of Philadelphia. So we are living this economic crisis with our consumer and commercial customers every day. It's interesting. The bank is working. Our branches never close for a day, so we are there supporting customers, saying very safely, making sure our colleagues are safe, our customers are safe, but taking care of the business that the banking business that remains essential, especially during these really trying times. So this is for all of us bankers, these are literally the busiest of times, even though we work much of the time virtually. And it really is, as we were chatting a little earlier, it's kind of the new normal. And we had so many great learnings that we'll take forward. But again, it's about taking care of PPP and deferrals on mortgages and auto loans, all those things that we need to help, again, our consumers and commercial businesses get through this COVID-19 crisis and hopefully to the beginning of a recovery. And that's where we really want to get to our terrific guest speaker today, because again, Mark Zandi is the chief economist of Moody's Analytics, where he directs economic research. But again, Mark doesn't really, his full bio is on the screen, but Mark doesn't need much introduction because you can see him on CNBC and Meet the Press, and you can read him every Sunday in the Washington Post and the Philadelphia Inquirer with his really spot on economic analysis. And again, has been a guide to presidents and administrations in a major way. So we really are honored to have someone of Mark's credentials, and it's great to have this national leading economist still based here in Philadelphia. But again, also, Mark, the one little crossover we have, you work for Moody's Analytics. Citizens Bank is close with Moody. We all rely on Moody's for a lot of analysis. And my boss, our CEO, Bruce Van Saun, CEO of Citizens Financial Group, is on the Moody's board. So it's always a close connection here. But again, this is really critical times as we think about how we work through this pandemic leading to this incredibly unprecedented economic crisis, and how we get to a recovery and what the new normal looks like. So without further ado, let me pass it over to Mark Zandi for his really much appreciated commentary.
Thanks, Dan. Yeah, we have very close ties with Citizens. Great institution and very good relationship with your bank. So thank you. And it's good to be with you, Ben. Thanks for the invitation. And I think the way this will run is I have 4 parts to my comments, so I'll run through each part and then I'll stop, and then we'll see if there are any questions or comments that folks have. So if you have a question or comment, you can, I think, pose that through the Zoom.
In the chat section, and we'll try and monitor that and then read them as they come up.
Great. And I'm just going to, whoever's operating the slides, I'm just going to let you know when to move forward. Okay, Ben, great. Fantastic. Excellent. So 4 parts. Part 1 is just, you should soak this in because this is the high point. We're at the apex of the worst of it. The economic shock has been cataclysmic, but we're about ready to make a turn, and I'll go through that. But then part 2, on the other side of the business reopenings, the economy is going to struggle until we have a vaccine, and a lot of uncertainty around that. But until we have that vaccine, I just don't see this economy going very far, very fast. Part 3, I'll talk a little bit about asset prices, if folks are interested, stock prices, real estate values, if you have an interest in that. And then part 4, we can talk a little bit about the longer term implications of this, because I think this has a long tail. This is going to have very significant impacts on business models and ways of doing business that hard to fathom at the moment, but are going to play out over the next few years. So with that as a guide to the agenda, part 1, it has been a cataclysmic economic shock. Pick your statistic. The job market does a really good job of telling the story. We lost 1 million jobs in March. We lost over 20 million in April. We're going to lose 3 or 4 million in May because the Bureau of Labor Statistics, the agency that collects the data, is conducting their survey this week. So we'll lose another 3, 4 million. So all in, we're going to lose 25 million jobs peak to trough. Bottom will be May in terms of jobs. That doesn't include folks that are still working but have lost hours and others that have lost pay. You can consider all those people. That's about 50 million workers. That's 1/3 of the workforce has been directly impacted by the virus. You can see it in unemployment. That's what I'm showing here. The blue line is the so-called U3 unemployment rate. That's the traditional measure of unemployment. We're up to nearly 15%. That's May. That's going to jump excuse me, that's April. That's going to jump again in May this month to closer to 20%. And then the U6 measure is a broader measure of underemployment. To be considered unemployed, you need to be out of work and not actively searching for work, which obviously many people can't because of sheltering in place, and many people are on furlough, so not actively searching. So that broader measure of underemployment will hit close to 30% in May when we get the data this week. So obviously cataclysmic. We haven't seen anything like this since the Great Depression. But the good news is we're now making a turn here, and the economy should start to feel much better by Memorial Day. And I think between Memorial Day through Labor Day, it's going to feel better for two key reasons. One, business reopenings. And Ben, if you can move forward, you get a sense of that here. This shows the number, the green bar right-hand scale shows the number of counties nationwide that are shut down. This was as of a few days ago. You can see roughly 2,500 counties were closed down at the peak. We're now down to 1,200, and it's falling fast. In terms of the share of GDP, that's the value of all the things that we produce. That's the blue line left-hand scale. About 30% of the nation's GDP was shut down back a month ago. It's now down to about 20. And I do think by Labor Day, we'll be pretty close to fully open. There still will be some industries, sectors that can't reopen because they bring large groups of people together. Spectator sports, amusement, and of course, we're going to see other industries, restaurants, good example, where businesses can't operate at full capacity because of various social distancing and virus mitigation efforts. But we're going to see a bounce in jobs over the next several months. So by Labor Day, we're going to recover half the jobs we lost. So we're going to lose 25 million, peak to trough, February to May. We're going to get 12 million of those back by September. Unemployment's going to go from 20% in May to about 10% in September. The other reason for a bit of optimism is we're getting a lot of help from the Fed and from Congress and administration. Ben, you can move forward. The Fed has done a very good job, the Federal Reserve, erecting a firewall between the economy, the mess in the economy, and the financial system. It was a nip and tuck there 4 or 6 weeks ago, but credit markets looked like they were going to freeze up, but the Fed did an admirable job, put interest rates at zero, ease capital reserve liquidity requirements for banks, has been buying billions of bonds, and that's what you're seeing here. This shows the bonds on the Fed's balance sheet. We're now up to over $6 trillion on the balance sheet, and it's going skyward as they buy treasuries, mortgage-backed securities, increasingly other types of fixed income assets in an effort to keep credit markets intact and flowing. And so far, so good. And also lawmakers, Congress and administration have really stepped up, and Ben, you can move forward. This shows you the amount of money coming into the economy. There's been 3 fiscal rescue packages totaling $2.9 trillion in total support to the economy. And this shows how much has actually gotten into the economy as of the end of last week. 1.1 trillion has gotten into the economy. Just for context, that's 5% of GDP. That's a lot of cash. Big chunk of that is I heard, I think Dan mentioned the Paycheck Protection Program. That's that will ultimately $650 billion. Economic impact payments, those are the stimulus checks. So my son and daughter got that. Some aid to states to help with healthcare costs, unemployment insurance, and then some other benefits. The money is getting into the economy very, very quickly, much more quickly than did the stimulus package that was passed in the middle of the financial crisis. That package was about 10% of GDP, but that took a while to get into the economy. This money is getting into the economy very quickly. that's a plus. Obviously, it's really helped to cushion the blow. So many households' cash flow has remained unchanged or close to unchanged despite losing jobs, hours, and wages. But we're blowing through the money very, very quickly. So by September, October, all the money is going to be gone unless Congress and the administration ante up and come forward with another rescue package. But for the time being, this is very helpful and a reason to be optimistic about the economy's prospects over the next several months. It's going to feel better over the summer months. Okay, I'm going to stop there. And Ben, are there any questions or comments that folks might have that I could take at that point, or should I move on?
Does anybody have anything in the chat?
And I'd like to ask something if I could.
Sure, please.
This is Paul Steinke. Mark, you and I used to work together back at WIFA.
Yeah. Hey, Paul.
In the late 80s.
You're looking good.
Thank you, as are you.
Thank you.
My question for you is, what is the outside limit of the federal government's capability of providing liquidity? For example, if we don't get a vaccine and the economy continues to really struggle because of it, is there a kind of upside limit to the amount of monetary relief that the federal government can provide over a longer period of time? And we're talking here about, we're only about 2 months in, but what if we're still kind of in the same place by the end of next winter, for example?
We have room to maneuver. The Fed and Congress and the administration have a lot of firepower. The Fed can continue to purchase bonds, equity, whatever they need. They could buy a Picasso painting if they had to keep things moving forward for a long time to come. And of course, the Congress and administration could continue to borrow money to finance stimulus checks and UI and paycheck protection, whatever. The only limit is, the only limit really is if that ultimately results in inflationary pressures. I mean, you're basically creating money, and that money will be used to buy things that aren't being produced. And at some point, you get an inflationary problem. And this is, something that's plagued emerging market economies. If you go back to Weimar Republic, that's the classic example of that. So that would be the limit. I would say that we have plenty of room between now and then before that would happen. And many other countries have much less room than we do. So if there's going to be a problem, it's going to start showing up in other places in the world long before it shows up here. But that's where the issues will be. That's where the concerns.
Ben, I had a question.
We've reached the point where deficits and debt really don't matter.
They don't matter until they do matter. And actually, I'll come back to that when we talk about some of the longer term issues, because I do think that's going to be a challenge on the other side of the pandemic, because every country in the world is borrowing aggressively to support their economies, as they should. There's really no good choice here, because if they don't, then the economy evaporates and their fiscal problems will be even worse. So that's a judgment call, but I think that's a pretty reasonable judgment.
Great.
But on the other side, there's going to be a day of reckoning. Much like remember the European debt crisis in 2010, 11, 12, 13?
Yes.
That was the day of reckoning for Europe on the other side of the financial crisis. We'll have a similar kind of problem here. Again, we're the strongest link in the chain. The weak links will start to go, and that's going to be emerging markets. I'll show some charts like Turkey and Egypt, South Africa, and then it'll show up in Europe, because the Europeans are really they have much less than we do to maneuver, both in terms of monetary and fiscal policy.
Mark,
question.
John, 1 second. We had
sure.
a question. I'm not sure if this was partially answered. What will this do to future inflation?
Well, it depends on how long this goes on. I mean, I think the assumption that we have a vaccine by this time next year or the year after, then I don't think inflation is going to be the issue. I think we'll we're going to be grappling with high unemployment, weak labor markets, weak wages, disinflation and deflation. However, it continues to go on. If we can't solve this problem medically, and we're here 3, 4, 5 years from now, we're still borrowing money to finance our living, and we're not producing, people can't work because they're sick or they can't come out, then the inflation will become a real problem. So it depends to some degree on how long this goes on, but under more reasonable, I think, assumptions that it lasts a year or two, our problem isn't going to be inflation, it's going to be deflation, disinflation, those concerns, because of what's going on in the job market.
John, you still have your question?
Can I ask Mark?
John Finley?
Go ahead.
Yeah. Hi, Mark. John Finley calling John Finley, Ocean First Bank. Mark, two things that I saw in the last couple of days. One, of course, as Dan said, we've been working the PPPs. All the banks have been doing a great job with their customers, but that money's not being used. I read where 30 to 40% is still unused. So, and then I saw something in the last couple of days that the $600 billion stimulus package that was going to airlines and others hasn't even gotten off the ground yet. Are they just stumbling blocks with the SBA or the?
Yeah, the PPP did a great job of distributing cash quickly, but it's now got hung up on what are the criteria for the loan to become a grant. So as you know, it's a loan, and if you do, if you stick to the script and do what you're supposed to do, money going to your workers and so forth and so on,
right?
And it turns into a grant. But there's a lot of confusion, not a lot of clarity with regard to those criteria, how they're going to be
forgiven. Yeah.
And the Treasury's been going back and forth a bit. SBA's always been a bit confused. And so that's making businesses nervous. And so they're not using it to the same degree as you would hope. And then there's just general confusion. I'll give you an example. I'm the lead director of Reinvestment Fund, which is, Philly-based CDFI, one of the largest in the country. We got a PPP loan of 1.4 million. And then we got guidance that, even though we're a nonprofit, a financial institution can't get PPP after, you'll be carved back. So we gave the money back. And then one day later, we learned, oh no, that's wrong. You can keep the money. So, it's that kind of stuff, So, but other, I got to cut the administration and Congress a bit of a break here because they, this is on the fly, very quick, So it's not at all surprising we'd have a bit of a mess at some point. We're in the mess. I will say though, if we go off the rails again, if we have a second wave, if we have to provide another round of support, I don't think I'd go down the PPP path. There's better ways of doing this we can talk about that are kind of working their way through Congress now that I think would be, there's this thing called the employee retention tax credit, which was part of CARES, can be significantly enhanced so that all businesses of all sizes could benefit. And that's a much better way of getting cash into people's hands and giving them operating expenses and also tying the labor force into them, paying wages. And that proposal is kind of making its way through. And I think if things go off the rails again, we're not going to get another tranche of PPP. We'll get something like what I'll call an enhanced ERTC, program. I think there's better ways.
We have a real estate question. Why haven't we seen a decline in prices of residential homes like in 2008? And what do you feel will be an impact on commercial real estate as companies realize that workers can work remotely?
Why don't we do this? That's going to be in my third section on asset prices. Why don't we move forward? All right, we can stop with the slides. I could just answer questions. Which would you prefer? Would you want me to move forward? Show some.
Carol's saying something. Move forward.
Move forward. Okay.
Yeah, I'd love
Let's go forward for a little bit. Yeah.
Okay.
Yeah, we
Okay.
should have it organized for us. Yeah.
Yeah. Okay. So part two, the recovery is going to be fragile on the other side of the business reopening. So as I mentioned, we're going to, feel pretty good through Labor Day. Once businesses are opened as much as they're going to be opened and the stimulus starts to fade, the economy is going to go sideways until we have a vaccine that is widely distributed and adopted, which, could be a while. And my baseline view, in the middle of the distribution of possible outcomes, I'm assuming that's a year from now. But obviously a boatload of uncertainty around that. And so I think it's fair to say that this recovery we're now just beginning will not be a V. The V is big down, big up, and we've had V's in the past, and that's what's shown here. That's the period after the 2001 recession. This shows the percent change in GDP since the beginning of each of these 4 recessionary periods. 2001 is the red line, and you can see we had the recession, and pretty soon, this was, remember 01, that was 9/11, that was the equity market crash. It was a mild recession. Then we really got going, and the economy 12 quarters later, 3 years later, was off and running. That's a V. That's a strong recovery. It's not going to be, I don't think, a W. Possibly could, but that's what we got in the 1980s. That was when Paul Volcker was chairman of the Federal Reserve, and he was battling inflation. He pushed the economy into recession, then let up, and then pushed the economy back in recession. That's the blue line, kind of a W. You can kind of see it. I don't think it's going to be a U or an L. That was coming out of the financial crisis. That's the 2007 recession. That's the gray line. You can see even 3 years after, we didn't even make our way back to the beginning of the recession in terms of GDP. That was deleveraging, a lot of overhang from that downturn. I would call this a swoosh. That's the light blue dotted line. You can see kind of the big down in Q2, businesses closed, a big up in Q3, that's where we are today, and then basically sideways until mid next year. And then once we get the vaccine, things start to kick back into gear. So it's not a V. It could, clearly could be, it depends on how the virus goes here, if there's re-intensification, but my sense is it's going to be more like, let's call it a swoosh, a Nike swoosh. And let me give you a few reasons why this economy is not going to come roaring back on the other side of the reopenings. First and foremost, people are just going to be nervous, and you can see how nervous businesses are in the next slide, Ben, if you move forward. We run a survey every week off of one of our websites. We've been doing it since 2003. It's a global survey, and we ask a lot of questions. I'm showing the responses to 3 of the questions here. The blue line is the percent of respondents that say they are investing. The green line are the percent that say they are hiring, and the red line are the percent that say they're raising prices. And you can see how shell-shocked businesses are. In fact, last week, not a single business, this has never happened in the survey, not a single business said they were investing, which is, gives you a sense of how nervous businesses are. Even look back into the financial crisis back in 2008, 2009. At the peak of that crisis, 25-30% of businesses were investing. So I think, businesses will feel better, once they're up and running, but I don't think they're going to feel like it's a time to take a chance and go out and expand and take risk until we get that vaccine. So businesses are going to remain very cautious. So will consumers, right? I think people are going to have one hand on the bunker door until they feel comfortable that they're not going to get sick, or they're not going to get someone else sick in their household. So that could be a while. The other reason for some concern, if you move forward, Ben, about the recovery is we're going to see a lot of business failures. Businesses, particularly smaller businesses, are running on fumes, and I think many will fail. This shows, to give you a sense of that here, this is our forecast for the number of bankruptcies across the country. I'm showing you data back to the first quarter of 2000 and our forecast through mid-decade. You can see the financial crisis, how many bankruptcies occurred during that period. This period isn't going to be quite as bad just because it's going to be shorter lived, and the crisis 10 years ago was centered around leverage and debt. So I don't think that'll be the case here, but nonetheless, it's going to be very painful. This, though, are bankruptcies. Failures are going to mount. Just to give you a sense of that, there are 8 million business establishments across the country. 4.5 million have fewer than 4 employees. 6 million have fewer than 10. If you told me, a year and a half from now, there are a million of those 8 million establishments are no longer with us, I'd say that sounds about right. It's going to be pretty significant. And that means even when businesses reopen, many won't. And that means many people won't get back to work. And that's why, one of the reasons why I expect we're going to only get half the jobs back that we're going to lose here by late this year. It's going to be a long time before we fully recover all of the jobs that we're losing here. I'll give you one more reason for a little bit of cautiousness. Typically, coming out of recessions, there's one part of the global economy that navigated the recession reasonably well and is leading the way out. China did that, for example, coming out of the financial crisis. That's not the case this go around. Every part of the world is engulfed in this, and there's no engine of growth. So that makes things difficult. I mean, you can see that in China. So the Chinese, kind of 2 months ahead of us, and they've controlled the virus much better than we have, and they're at 80-85% because they can't sell what they're producing to the rest of the world because no one else is buying. 20% of their GDP is export. So that just gives you a sense of the drag there. Of course, a lot depends on your epidemiological assumptions. Ben, you can move forward. This gives you a sense of our expectations for GDP growth under 3 scenarios. I've been focused so far just on the baseline, most likely scenario, our assumption of a vaccine that's widely distributed and adopted by this time next year. But we run lots of different scenarios for banks. Citizens, for example, use all these scenarios when they do loan loss provisioning and that kind of thing. And many of them are looking at the downside. That S4 scenario, that's 4% probability that things will be worse. You can see how ugly that is. We are assuming that we don't get a vaccine until into 2022. So much higher unemployment. I will say this: if we have a significant second wave of virus later this fall, when we're on the other side of the business reopenings, we'll go back into recession, and I think this period will go down as being called a depression, not a recession. And in my nomenclature, depression is a period of double-digit unemployment for more than 2 years. So I think that would be our likely outlook if things re-intensify here. I did want to say a little bit about what's going on regionally, just given your interest, and Ben, you can move forward. This shows a map of the country. These are all the metropolitan areas across the country, 400 plus, and this gives you a very quick, clear sense of who's most at risk. The areas in red are areas that are most vulnerable to the economic fallout from the virus, and you can see, obviously the New York City area is getting creamed. Boston, we're going to navigate through a bit better, but still it's going to be more difficult. Florida, parts of Texas, California. This goes to industry mix. So if you have a lot of tourism, travel related activities, you've got a problem. If you've got if you're a hotspot, you got a problem. Areas that depend on people moving in, they've got a problem because people can't move. All those things are accounted for, and some other things. The age distribution of the population are accounted for in this calculation. Okay, Ben, I'm going to stop there and turn it back to you and see, before we move on to stock prices and real estate values, what other questions people might have on that, if they have any.
Does anyone have an immediate question? Because before that, people were interested in the slides.
Okay, Bill, you got to unmute. You need to unmute. Yep.
I'm trying.
There you go.
So wonderful information. You're presenting it so I can understand it, which is even better for me. But question that I have, Mark, is with reference to both the pandemic as well as the pandemic compensation as well as unemployment compensation. How does this significant or this somewhat bleak picture of business failures impact on the future of those independent businesses that are getting unemployment compensation now?
I'm sorry, Bill. Could you I just got distracted for a second. Could you?
Sure. So for those independent businesses who are currently being able to participate in the pandemic, as well as unemployment compensation because they're employed, but their customers are not giving them any work because they are in shelter in place. How long do you see unemployment? Right now, I guess that the pandemic unemployment is projected to go into the middle of July, and then regular unemployment would go to the end of October. Do you see that being extended because of this projection?
Yeah, my guess is we will get another package from Congress before all is said and done, and that package will include some additional unemployment insurance benefits. That's high on the priority list for the Democrats. So I think that will be part of the package. So the enhanced UI that expires in July probably will go out another 3 months. That would be my sense of it. There also will be additional aid to state governments, state and local governments, because right now they have huge budget holes. They have no way to fill it. They have balanced budget laws that can't borrow money to fill the budget hole, and so they're laying off workers very aggressively. In fact, in April they laid off 1 million workers, 5% of their workforce. So I think that's coming. I do think there's going to be the quid pro quo for Republicans will be some liability protection for businesses. There's a lot of concern, and I think a reasonable concern that businesses are going to get sued. If people get sick, if they come into their establishment, and so there's got to be some form of protection there. That's a difficult balancing act, but I think ultimately that'll be part of the package. So I'm expecting another, and then it does depend to some degree on how things go between now and Labor Day. If things go about as I expect, then that probably will be the extent of the package. If things go worse, if the business reopenings are not as extensive, or we have re-intensification of the virus and businesses don't open or people don't get out of their bunker, then the package will be larger. But UI will be at the top of the list. I'm pretty sure. Yeah.
Thank you.
Marty, do you still have a question?
Sure. I don't know if my video is working. I don't know.
Yep.
But anyway, Mark, good to hear from you. I'd be interested in you looking at the Philadelphia region in terms of its impact, the impact we can anticipate on various sectors, whether that's office, hospitality, of course, hotel, restaurant, public venues, eds, meds. There's a lot that drives our revitalization in Philadelphia over the last 5 to 10 years, and I'd be interested in seeing how you imagine the other side of this.
Yeah, I think Philadelphia will navigate. We'll get hurt, obviously. This is unambiguously bad for us here in Philly, but I think we'll navigate better than many other large urban areas. In part because of our industry mix. I mean, the eds and the meds, that should cushion the blow to some degree. I mean, they're under pressure too, though. I mean, the universities have some big issues to work through, but I think the universities we have in the city are, world-class, and they'll be fine. And actually, in the long run, they may benefit because there's going to be a lot of other universities that fail, and just there'll be concentration in larger universities that operate in Philadelphia. And also the medical community, obviously the hospitals have gotten crushed here because of the inability to do elective surgery and that kind of thing. But we're going to get on the other side of that, and they'll be fine. And those are generally stable jobs and good paying, and so I think we're in pretty good shape. We also have some financial services, so that helps, I think that should help cushion the blow. So I think broadly speaking, it's going to be a negative. It diminishes our economy, the Philadelphia economy, but we'll do much better than many other large urban areas, obviously relative to New York or Chicago. The other thing I'll say is, and this goes to real estate, which I'll talk about in a second, I do think all all urban areas will be diminished to some degree because, people are more likely to work remotely on the other side of this. I also think globalization, the process of things that include trade and immigration and investment, things that really have benefited urban centers will be impaired by all this. That, every country's been erecting borders for good reason. They'll bring those borders down, those barriers down, but that's going to take time, and they're not coming back in the same way. Businesses are going to change their global supply chains. They're going to be quite as long, and they're going to bring them in, and that means that cities, urban areas that are more globally oriented will get hurt more than other parts of the country. Philly is, isn't quite as globalized. So again, we should be able to navigate better than a Miami or, a Houston or an LA or San Francisco. But again, we'll be diminished by it. We'll be hurt by it. So on an absolute basis, this is not good. And it's going to be a problem for a while, a long time to come. But on a relative basis, we're going to navigate better than most other urban areas across the country.
So we'll do one more question. Gail had a question, and then we'll go back to the slides.
Yeah,
Gail,
hi,
are you
Mark.
there?
I'm here. Can you hear me?
I can.
This has been really great. Thank you so much for coming and speaking to us, and you're giving us a lot of hope. I'm curious though, since only a few people started this virus traveling all over the world, what's making you hopeful that we're going to contain it by the fall in terms of not a resurgence? You seem to be really hopeful about that. So you must have information at your disposal to be thinking that way.
No, I'm not confident at all. No, sorry. No, I don't know. I don't think anybody does. That's just, when you have to put numbers in a database so that people can use them, you have to, say, what is your explicit assumption for your most likely scenario? And that assumption is we will have some re-intensification as businesses reopen, but that it doesn't lead to widespread business shutdowns again. That's the working assumption, but I don't have any confidence at all in that. And therefore, that's why we need to consider a wide range of scenarios, many of whom are darker than I just described. And that's my inclination to go be darker here than more positive, at least in the near term, at least through the remainder of this year. And that's another reason why I don't think the economy goes anywhere, because of that uncertainty. I'm telling you, I don't know, nobody knows. So you're a business person's taking that information and you go, oh shit, what do I do with that? Well, the answer is you sit on your hands. You don't do anything with that. You're not going to take a big risk. You're not going to go out to Citizens and take out a big C&I loan to go expand your business. You're just not going to do it. And that's why, we're going to be struggling here until we get a vaccine. So no, I don't have confidence. And practically speaking, you have to say this is the middle of the distribution of possible outcomes. And that's the assumption I'm making. But you can make a different one. I will say this, and I don't know what you should take away from it, if anything. If you look at other forecasters that do this thing for a living, economists that do this for a living, their assumptions are pretty consistent with mine. So it's kind of, we've coalesced around this. It's not like we have a club and we all meet and say, oh, what are we going to assume? So we all kind of came to it separately. So I don't know if that gives you any confidence or not, but that's just a data point to consider. Okay, let's move forward and let's just talk quickly about asset prices. And sorry, just one thing. I just had a CNN interview. That's why they're moving things around. And you should know, I said no to them moving things up because I'm talking to you. So I said, no, I can't do that. But I do need to leave unless they blow me off at 11:55. So sorry about that. On asset prices. So stock prices, as you can see, have come a long way back. This shows the value of all publicly traded stock back to the beginning of the year. This is the Wilshire 5000. It was trading at 34 trillion before this mess. Hit bottom at late March at 22 trillion. this does not include yesterday. So we're probably around 30 trillion now. So we're only down about 4 trillion from the peak, which only, it's a lot, but it's, it's not what it was. I will say 2 things about this. One, it makes sense to me that we've seen the bottom in equity prices because of what the Federal Reserve has done. The Fed is basically telling investors, I got your back. I'm going to do what it is ever necessary to make sure that the financial system and the equity market, hang together reasonably well. So don't worry about the downside risk. We're not, we might go down again, but we're not going to blow through that previous floor. Second point I make is I don't think we've seen the script here on the bear market is not over. I think markets are looking at this balance in economic activity that we expect this summer, and optimism around a vaccine, and that's what's driving this rally in equity prices. Once it becomes clear that after this bounce we're going to go sideways, it's not a V, I think equity investors are going to reevaluate, and we're going to see another move down in prices later this summer, going into the fall. And my guess is on the vaccine, that's just going to be up on positive news, down on more negative news, and we're going to get both between now and the time when we actually get a vaccine. This isn't going to be, logic dictates this isn't going to be a straight line. And finally, I'll say on this is if we do have a re-intensification of the virus, a second wave that does cause business to shut down again, that's the fodder for depression, and we're going to blow through the floor. So we're going to get everything's going to get tested again. So if that's the path of the virus, the epidemiology of the virus, then we got another set of problems down the road. On real estate values, Ben, you can move forward. I do expect price declines. There you go. The blue line, the dark blue line here is the house price index for Fannie Freddie loans. FHFA is the regulator for Fannie Mae, Freddie Mac. These are loans to middle-income Americans. About half of all loans are Fannie Freddie loans. This is just an index. Repeat sales. I'm tracking the same transactions over time. Index equal 100 in Q4 2019. You can see I expect price declines nationwide, modest, 0 to 5%, because I do think later this year, when various forbearance and foreclosure moratoria run off, we will see credit problems, more foreclosure, and we'll get those foreclosure sales, and that'll depress prices. But I do think the market's going to hold up reasonably well, in part because it's undersupplied. The high-end apartment market is oversupplied, but the lower price points of the market are undersupplied, including in Philadelphia. Vacancy rates are very low, and that puts a proverbial floor under prices. The other reason for a bit of optimism here is there was no speculation in these markets, very little. Some creeping in. Actually, Philly felt a little bit like it was getting a little frothy right before the virus hit, but that's small in the grand scheme of things. So no real out of bounds kind of speculation. House prices were pretty consistent with rents, incomes, and construction costs, and that will limit the downside. And of course, the other reason I mentioned earlier is government support. Look at CRE though, commercial real estate values. That's the light blue line. There I expect big price declines, down 20, 25% from the peak. This market was overvalued coming into this, particularly in large urban global gateway cities. A lot of foreign investors coming in, buying at very low cap rates. Some Chinese investors didn't even care if they had a cap rate. All they wanted was money good, 4 or 5 years down the road. Here, there's no real government support. There's a little bit of support on the commercial mortgage-backed securities market, but other than that, the government's not coming in to help in any way. And then the other reason I think prices are going to weaken is on the demand side. No sector of the economy is going to get hit harder by the longer-term implications of this virus than CRE. It's and it's just reinforcing trends that were in place before this. Move from brick and mortar to online. Of course, hotels are going to get hammered because business travel is not going back to where it was. Just not. I mean, I have 200 economists that work for me across the country, across the globe, and after labor and rent, my biggest expense was travel. And after these Zoom events, there's no way we're going back to the kind of travel we had before. It's just not happening. So I think businesses across the world are going to behave the same way. They're just not going to have the same kind of travel. I think people are going to change the way they work from home. Moody's already putting space back all over the world. Of course, Moody's has the highest cost, space in the world. We're in, New York and London and Singapore and Hong Kong and San Francisco. Philadelphia, believe it or not, in all the offices that we have across the world, there's only one other office whose rent's cheaper than my office here in Westchester, Pennsylvania, and that's Prague. It's the only place in the world where we have lower rents. So Westchester is going to be good. This is another reason why Philly might navigate a little bit better than other places. We are lower cost, and people value that if they can move, and this may let people move. So I can have a job with Moody's and live in a much nicer, bigger home in Philadelphia than I live in in New York, and the taxes are lower. So Philly might actually benefit because it's a low cost choice, in the Northeast corridor, that kind of thing. And we couldn't really take advantage of that. I always thought the only way to take advantage of that was to improve the rail system so that people could commute in 45 minutes, to New York and DC. But now this may change the ball game, for Philadelphia. We may actually see people move because they can. They don't need to be, living in New York or living in DC. But I think commercial real estate will have one of the most significant adjustments going forward. I'll stop right there and see what people want to do.
People were interested in your slides, so I don't know if you want to finish that.
Okay.
But
yeah. Okay. Sure. So let's go to part 4 in the long term, and I'm going to mention 2 long term. I've already talked about CRE, but let me mention 2 other things longer run that I think people should be cognizant of. Well, first of all, it's going to be a long road. The baseline. This is just jobs, total employment, millions of jobs. My baseline is the green line. You can see we were at 152.3 million at the peak before this mess. You can see where we're now, and it's going to take us until roughly 2023, 3 years from now, to get back the jobs we lost now. That's my baseline. Look at my downside scenario. There we don't get back into mid 2024, and in that 4% scenario, we don't get back to the employment levels we had prior to the recession until 2027. So this is a long road ahead. 2 big issues that we're going to have to grapple with on the other side of the pandemic. The first, Ben, you can move forward, is I mentioned the fiscal problems, debts and deficits. This gives you a sense who's most at risk. The x-axis, the horizontal axis, is the debt to GDP ratio for these countries. Each circle is a country, this representative of the size of the country. The y-axis, the vertical axis, is the so-called fiscal space. That's the difference between actual debt to GDP and that debt to GDP ratio above which the country will get into a self-reinforcing negative cycle. So investors see debt rise. They demand higher interest rates to compensate for the risk they might not get paid back in a timely way. That adds to the interest payments of the government. Deficits and debt rise more, and you can see how you can get into this vicious cycle. And these countries that have no fiscal space, Turkey, South Africa, Egypt, Argentina, Greece, Italy, Japan's a special case, wouldn't pay much attention to that, but the others, they are already on the edge of that vicious cycle. And this chart was done before COVID, so all those bubbles are going to be moving down and to the right, and the risks here are going to rise that on the other side of this mess, because our deficit and debt are going to be much higher, that we are going to have a fiscal event, crisis, something, which by the way, in my view, is the only way that we will find the political will ever to address our deficit and debt. Unless we're under pressure, unless we can connect the dots between deficit and debt and the economy, and it's bad for the economy, we're never going to change our policies. And I do think that will require some kind of crisis, and that probably will occur on the other side of this in 2022, 2023. So just when you think we're free and clear, we're going to have to grapple with that particular issue. And then finally, I mentioned this, I won't go into any depth, just the globalization will be impaired. globalization, trade, immigration, foreign investment were already on its back heels before this because of the financial crisis. President Trump obviously is very anti-globalization. If he is reelected, this was going to happen anyway. But now with COVID, I think that means that we're going to be a much more globalized economy going forward, which diminishes our economy, particularly urban areas, particularly urban, core urban center, core globalized cities like New York and Chicago and San Francisco and Miami. But I'll stop right there. I covered a lot of ground and see if there are any other questions that people might have.
Do you have to leave in a minute or so, or?
Yeah, I've got 5 minutes. They just gave me 5-minute warnings. So sorry about this.
No, it's okay. Does anyone have time for one question, 2 questions? There's a lot of thank yous in the chat.
Is it possible to get a copy of the slides? That would be my question.
They're yours. You can, Ben, you can distribute them.
Yep. If I can ask a question, Dan Fitzpatrick, Mark, great presentation. I mean, I guess the big thing is going to be sector by sector, industry by industry, winners and losers in the new world. Any sense of that as you're starting to forecast going forward? You talk a lot about aggregate demand, but obviously it's going to be very different depending on what industry you're in.
Yeah, that's a great question, Dan. And we actually collect data from this firm called Cortera. I don't know if you know them. They're D&B-like competitor. They track accounts receivables for about $1.5 trillion in B2B spending across the country. And they have very good, timely data across detailed industry, region, business size. And looking at that data, it's very intuitive, but I think it's the future. So accommodation, restaurants, motion pictures, amusement, those are the industries that are going to struggle here. Maybe I'll just quickly pull it up if I can. I'm just going to read you that these are industries that are struggling the most in terms of the decline in their B2B spending and in terms of their late payments. So here's the top 10. 10 worst. I'll give you the 10 hardest hit, and then I'll give you the 10 that are navigating the best. So top 10 worst. Performing arts, accommodation, motion pictures, transportation equipment, clothing, stores, museums, amusement, gaming, recreation, sporting goods, gasoline stations. Those are the industries that are getting hit hardest, and I think will struggle the most longer run. And then here's the industries that are navigating well: online retailers, broadcasting, electronic stores, merchant wholesalers, again to online, health and personal care stores, nursing, residential care facilities, data processing, waste management, food manufacturing, repair and maintenance, couriers and messengers. So I think that kind of gives you a sense of it. It's very intuitive, I think, and I think that gives you a window into who's going to do well or who's going to struggle more in the next foreseeable future.
Thanks, that's helpful.
So Mark, we just want to thank you. I don't know if you've seen the chats, but everybody has said that it's been very valuable information and great slides. We know you have to run. We'll try and catch you on CNN. If anybody does want to stay and continue the conversation, we can hang out and do a little networking. But with that, we just wanted to thank everybody for coming, for hanging with us. And again, for the sponsors for all of their support. And Mark, we'll watch for your interview. Okay, take care.
Bye-bye.